stock prices have reached what looks like a permanently high plateau. That was not the rambling of a lunatic on a street corner. That was the ironclad declaration of Irving Fisher, the most brilliant economic mind at Yale University. He said it exactly 9 days before the entire global financial system collapsed and wiped out $30 billion. For nearly a century, the history textbooks have sold you a comforting lie. They teach you that the Great Depression of 1929 was an unfortunate accident, a cyclical failure of capitalism, a financial natural disaster that no one could have possibly predicted. But today, we are going to drag you out of that fog of sweet delusions. Look closely into the shadows of the mahogany boardrooms of Lower Manhattan in the 1920s. The Great Depression was never an accident. It was a masterpiece of betrayal. It was a high society dinner party, meticulously designed by the financial elites of Wall Street. The naive public was invited simply to be the main course, while the men who built the machine quietly walked out the back door with their pockets overflowing. Welcome to the Roaring Twenties, an era where America believed it had finally discovered the ultimate alchemy of permanent wealth. Reckless consumption, fueled by unlimited speculation. History looks back at this decade as a golden age of progress. Cars, radios, and electric refrigerators flooded into middle-class homes. People spoke of an American dream where poverty would be permanently erased under the benevolent guidance of Wall Street's financial gods. But beneath the blinding glare of the neon lights in the jazz clubs, a cold reality was being buried. The purchasing power of the American public had actually dried up by the middle of the decade. Factory wages were stalling, completely unable to keep pace with the massive industrial output. Warehouses were quietly filling up with radios nobody could afford to buy. Brand new cars sat rusting in open fields. So how do you maintain the illusion of an unstoppable economic juggernaut when the consumers are broke? The financial elite engineered a genius, lethal solution. If the people do not have the money to buy the goods, lend them the money. And if they want to get rich quick, turn the entire foundation of the American economy into a legalized casino called the New York Stock Exchange. The ultimate weapon used to lure the masses into the slaughterhouse was margin lending. It was a demonic mechanism perfectly disguised as Wall Street generosity. Imagine walking into a broker with just $10 in your pocket. The firm would happily lend you the remaining $90 to buy a stock worth $100. When the stock climbs to $110, you sell, you pay back the $90, and you double your money. It sounded too easy. A shoeshine boy, a barber, a cab driver could become a millionaire overnight without understanding a single thing about corporate fundamentals or actual valuation. But the elite never explained the other side of the blade. The margin loan was a lever with no safety catch. If that stock dropped just 10%, your entire initial investment evaporated instantly. And when the dreaded margin call came over the ticker tape, you were forced to inject more cash within hours. If you could not, your assets were violently liquidated at rock-bottom prices. The mastermind behind this toxic revolution was Charles Mitchell, the president of National City Bank. Mitchell realized something terrifyingly profitable. The wealth of the rich was finite, but the combined savings of millions of working-class Americans was an endless ocean of liquidity. He did something absolutely unprecedented in the history of banking. He transformed a conservative financial institution into a massive, aggressive retail stock brokerage. Mitchell deployed thousands of salesmen across the country. They opened brokerage offices in every major city. They aggressively pressured farmers and housewives to pull their last pennies from under their mattresses and throw them directly into the Wall Street casino. Let us look at the cold, hard numbers. The stock of the Radio Corporation of America, the absolute tech giant of its era, exploded from $85 to over $400 in a matter of months. The punchline? RCA had never paid a single penny in dividends to any of its shareholders. The public was not buying the stock because the company was profitable. They were buying it because they were mathematically conditioned to believe a greater fool would buy it for a higher price tomorrow. By 1928, the American stock market had completely divorced itself from economic reality. It became a parasitic entity, sucking the lifeblood out of the nation. While Wall Street drowned in champagne and paper profits, the actual physical economy was bleeding out. The agricultural sector was in a severe depression. Farmers were going bankrupt by the thousands as crop prices hit rock bottom. Small rural banks were drying up, starved of liquidity. Why? Because the massive New York banks, led by men like Charles Mitchell, were jacking up short-term interest rates to 20% for stockbrokers. Why on earth would a bank lend money to a farmer for a tractor at 5% when they could lend it to a Wall Street speculator at 20% to gamble on RCA? Over $8.5 billion in broker loans had been generated by 1929. That is a staggering, apocalyptic number. The amount of money borrowed simply to gamble on stocks was larger than the entire amount of physical currency circulating in the United States. It was a ticking time bomb stuffed with synthetic credit, resting on a rotting wooden foundation. Did the elite know this? Of course they did. They saw the empty warehouses. They saw the freight numbers crashing in the summer of 1929. But the music kept playing. The ticker tape kept spinning. Because the hosts of the party had not yet finished transferring their toxic paper garbage to the hands of the naive public. In the mahogany-lined boardrooms of Lower Manhattan, the architects of the 1920s financial boom realized a terrifying mathematical truth. The margin lending machine, as efficient as it was, had a critical bottleneck. It required actual shares of real companies to function. But by 1928, there simply weren't enough profitable corporations left in America to absorb the tidal wave of credit Charles Mitchell and his banking syndicate had unleashed. The solution they engineered was not a new industrial revolution. It was a masterpiece of legal fraud. They called it the investment trust. Today, we know it as the weapon of mass financial destruction that preempted the 2008 collateralized debt obligations by 80 years. To understand how Wall Street sold radioactive garbage for the price of solid gold, you have to look back at the psychological conditioning of the American public during World War I. Before 1917, the average citizen had never owned a security. Investing was a blood sport reserved exclusively for the elite. But to fund the war effort, the government launched the Liberty Bond campaign. They used Hollywood stars like Charlie Chaplin and Douglas Fairbanks to convince factory workers and farmers that buying paper certificates was a patriotic duty. Millions of working-class Americans purchased their very first bonds. The government had unwittingly trained an entire generation how to invest. When the war ended, Wall Street looked at this newly educated, highly gullible demographic and saw an ocean of untapped liquidity. The elites needed a way to extract this wealth without actually giving up equity in their own profitable enterprises. Enter the investment trust. The pitch to the public was deceptively simple. Why risk your hard-earned savings on a single company when you can buy a share in a trust managed by the smartest minds on Wall Street? These trusts would pool the money of thousands of small investors and build a diversified, bulletproof portfolio. It sounded like the ultimate democratization of wealth. It was, in reality, a meticulously designed vacuum cleaner pointed directly at the middle class. The mechanics of these trusts were a masterclass in obfuscation. They produced nothing. They built no factories, laid no railroads, and patented no inventions. They were merely holding companies, corporate ghosts created solely to hold the stock of other companies. But the greed of 1928 demanded more. Wall Street began creating holding companies that held the stock of other holding companies. A box containing an empty box containing another empty box. Let us dissect the anatomy of the Goldman Sachs Trading Corporation, launched in late 1928. It was the crown jewel of this synthetic wealth creation. Goldman Sachs issued the initial stock at $104 a share. Within weeks, driven by aggressive marketing and blind public faith, the price skyrocketed to $226. What did the corporation do with the hundreds of millions of dollars it raised from the public? It didn't invest in American industry. It used a massive portion of the capital to aggressively buy its own stock on the open market, artificially inflating the price even further. It was a perpetual motion machine of financial fiction. But the architects were not finished. In the summer of 1929, Goldman Sachs Trading Corporation sponsored a new entity called the Shenandoah Corporation. They issued millions of shares to the public, raising capital to buy more inflated stocks, including shares of Goldman itself. Just weeks later, Shenandoah sponsored yet another trust, the Blue Ridge Corporation. The leverage was stacked so high and the cross-ownership was so convoluted that a single dollar of actual corporate earnings at the bottom of the pyramid was being claimed as collateral by 5 different layers of holding companies at the top. The public was paying billions of dollars for the privilege of owning a fraction of a ghost. The creators of these trusts, however, took zero risk. They structured the deals so that they retained absolute voting control while putting up a fraction of the capital. More importantly, they charged exorbitant management fees, underwriting fees, and massive commissions on every single transaction. They were gutting the trusts from the inside out, front-running their own clients, and pocketing millions in cold, hard cash before the ink on the stock certificates was even dry. By late summer of 1929, the market was entirely saturated with these toxic instruments. Nearly 8 million Americans were directly or indirectly gambling in the stock market. The shoeshine boys, the taxi drivers, the barbers, they were all checking the ticker tape before eating lunch. The narrative was that America had achieved permanent prosperity. But in the private clubs of the financial elite, a very different conversation was taking place. Joseph Kennedy, a prominent speculator and insider, famously noticed his shoeshine boy offering him stock tips. For Kennedy, this was not a sign of a booming economy. It was the ultimate, flashing red warning light of a terminal market. When the lowest rung of the economic ladder is fully invested, there is no one left to buy. There is no new money left to enter the pyramid. The elite realized that the working class was no longer just a source of capital. They had become the perfect, unwitting exit liquidity. The smart money knew the foundations were rotting. Industrial production had been quietly contracting for months. Freight car loadings were down. Consumer debt was completely maxed out. The investment trusts were not a sign of economic strength. They were a desperate, final grift to keep the music playing just long enough for the insiders to secure their chairs. The trap had been perfectly set. The explosive charges of margin debt and toxic trusts were wired directly to the bank accounts of millions of American families. All that was required now was for someone to detonate the system, and the men who built the machine were already quietly walking toward the exits, their pockets overflowing, preparing to pull the plug on the greatest financial illusion in human history. By the late summer of 1929, the stench of decay was entirely masked by the perfume of artificial prosperity. The ticker tape continued its relentless upward climb, printing new millionaires every hour on the hour. But inside the private ledgers of America's real economy, a very different and terrifying story was unfolding. Steel production was plummeting. Car sales were stalling. Construction contracts had dropped to their lowest point in years. The physical machinery of the nation was grinding to a halt, choked by unsold inventory and tapped-out consumers whose purchasing power had been cannibalized by margin debt. The fundamentals were screaming that the economy was dying. Yet, the financial machine on Wall Street was accelerating faster than ever. This divergence between physical reality and paper wealth is the exact moment when the architects of the bubble transformed into its executioners. In March of 1929, a rare crack appeared in the facade of elite solidarity. Paul Warburg, one of the founding fathers of the Federal Reserve System, issued a stark, public warning. He stated that if the orgies of unrestrained speculation were not halted immediately, a collapse would bring about a general depression involving the entire country. The response from the public, the press, and his own peers was immediate and vicious. They mocked him relentlessly. They called him a pessimist, a relic of a bygone era who simply did not understand the new economic paradigm of permanent growth. But the smartest men in the room were not laughing at Paul Warburg. They were listening, and more importantly, they were acting. Bernard Baruch, a legendary speculator and political advisor, began quietly liquidating his massive stock portfolio in the summer of 1929. He did not issue press releases. He did not go to the newspapers to warn the public. He simply took his money off the casino table, converting his paper profits into hard gold and shifting his capital overseas to London. Joseph Kennedy, who had realized the game was fundamentally over when his shoeshine boy offered him stock tips, also began secretly dumping his shares. They were silently slipping out the back door while simultaneously telling the guests in the front room to keep drinking the champagne. But nobody mastered the art of the betrayal quite like Albert Wiggin. Wiggin was not some rogue independent speculator. He was the respected, powerful head of the Chase National Bank, one of the largest and most prestigious financial institutions in the world. As the chairman, Wiggins' public job was to project absolute confidence, to assure his depositors, his shareholders, and the American public that the bank and the market itself were completely sound. And he did exactly that, with a straight face. Throughout the fall of 1929, Wiggin publicly championed the underlying strength of the economy, encouraging the masses to hold their positions and confidently buy the dip. But what Wiggin did in the shadows is one of the most chilling acts of financial treason in modern history. Recognizing that the market was a fragile house of cards, waiting for a stiff breeze, Wiggin decided that simply selling his stock was not enough. He wanted to actively profit from the impending slaughter. Over a period of several weeks in September and October, Wiggin used a complex web of private, family-owned shell corporations, primarily one based across the border in Canada called the Shermar Corporation, to aggressively short-sell the stock of his very own bank. Let that sink in for a moment. The chairman of Chase National Bank was borrowing shares of Chase National Bank, selling them at the absolute peak of the bubble, with the explicit and calculated plan to buy them back at pennies on the dollar after the market crashed. He was actively betting against the institution he was paid millions to protect. He was betting against his own shareholders. He was betting against the very people he was publicly encouraging to buy. To execute this massive short position, Wiggin needed a tremendous amount of funds. Where did he get the money to finance his bet against his own bank? He borrowed it directly from the Chase National Bank. He used the bank's own capital to destroy its own value. It was a perfectly legal, ruthlessly efficient mechanism of wealth extraction. Wiggin and his peers were not waiting in fear for the crash. They were actively positioning themselves to be its primary beneficiaries. As October approached, the margin calls began to ripple through the system like localized, subterranean tremors. A few over-leveraged speculators were wiped out here and there, forcing sudden, unexplained dips in the market. The newspapers, fueled by Wall Street PR, called them healthy corrections. The banking syndicates occasionally formed pools to buy blocks of stocks and temporarily prop up the prices, creating a false sense of a market bottom. But this was never an attempt to save the market. This was a cynical attempt to create just enough artificial liquidity so the insiders could finish unloading their toxic garbage at premium prices. They needed the public to remain calm and keep buying just a little bit longer. The elites were effectively holding the door shut on a burning building, convincing the people trapped inside that the smoke was just a new type of incense, all while they stood safely outside with buckets of water they fully intended to sell back to the survivors. The fuse had burned all the way down to the powder keg. The structural integrity of the American economy was compromised beyond any hope of repair. The margin debt was too high, the leverage was too extreme, and the underlying corporate assets were completely hollow. The men who had built the machine were completely insulated, their fortunes safely diversified, hidden offshore, and heavily shorted against the inevitable collapse. All that remained was the final, devastating gravitational pull of reality. The clock was ticking toward Thursday, October 24th, the day the music would finally stop and the slaughter would begin. Thursday, October 24th, 1929. History remembers it as Black Thursday, the day the magnificent Wall Street wealth machine finally jammed. But it was not a sudden accident. It was the mathematical culmination of a decade of unchecked margin debt colliding with physical reality. The opening bell rang at 10 in the morning. Within minutes, the trading floor descended into absolute primal chaos. The volume of sell orders was so massive, so unprecedented, that the physical infrastructure of the New York Stock Exchange simply broke down. The ticker tape, the vital nervous system of the financial world, could not process the data. It fell behind by 10 minutes, then 30 minutes, then over an hour. This information lag was a psychological death sentence. Across the country, in the newly opened retail brokerage offices Charles Mitchell had built, millions of ordinary Americans stood watching the tape. They saw prices plummeting, but they knew they were looking at ghosts. The numbers printing on the tape were already an hour old. The current prices were an utter mystery, plunging into the dark abyss of a market with zero buyers. And then, the automated slaughter began. The margin calls. Brokers began sending out frantic telegrams demanding immediate cash deposits to cover the plunging collateral. But the communication lines were hopelessly jammed. People were wiped out before the telegrams even arrived at their doors. The automated liquidation algorithms of 1929 were human hands. Brokerage clerks ruthlessly dumped millions of shares onto the open market at whatever price they could get. This tidal wave of forced selling accelerated the collapse, triggering a brutal chain reaction of even more margin calls. By noon, the market had lost 11% of its value. Billions of dollars of synthetic wealth had simply evaporated into thin air. Crowds gathered outside the exchange, a sea of terrified faces, held back by hundreds of heavily armed police officers. Rumors of mass suicides spread like wildfire, but inside the luxurious offices of 23 Wall Street, the headquarters of J.P. Morgan and Company, the elite were not panicking. They were orchestrating a theatrical performance designed to extract the last remaining drops of liquidity from the dying system. At 1:30 in the afternoon, the doors of the exchange swung open. Richard Whitney, the vice president of the exchange and the designated floor broker for J.P. Morgan, strode onto the trading floor. The chaotic screaming instantly died down. The crowd parted for him like royalty. Whitney calmly walked to the trading post for United States Steel. In a loud, clear voice, he placed an order to buy 10,000 shares at $205, a price significantly above the current market level. He then walked from post to post, placing massive buy orders for blue-chip stocks. The total intervention was over $20 million. A cheer erupted from the floor. The bankers had arrived. The elite were saving the market. The newspapers the next day declared the panic was over. But they were completely wrong. Richard Whitney was not saving the market. He was executing a calculated, temporary short squeeze. The banking syndicate knew the system was doomed. Their dramatic intervention was a brilliant psychological trick. By creating a temporary floor and halting the panic, they manufactured a brief window of false confidence. A dead cat bounce. And during this brief window, over the next few days, while the public breathed a sigh of relief and held onto their shares, the insiders quietly liquidated their final, massive blocks of stock. They used the public's renewed optimism as exit liquidity. By the weekend, the banking syndicate had successfully unloaded their toxic assets. They stepped away from the machine. They let go of the lever. Tuesday, October 29th. Black Tuesday. The real slaughter. The day the bankers did not step in. The floor simply vanished beneath the market. 16,410,000 shares were traded in a single day, a record that would not be broken for nearly 40 years. Some stocks, like White Sewing Machine, collapsed from $48 to $1. Entire fortunes built over a lifetime were incinerated in a matter of seconds. $30 billion vanished. To put that number in perspective, $30 billion was more than the entire cost of the United States' involvement in World War I. The great American wealth machine had been stripped bare, leaving nothing but a smoldering crater of debt. The aftermath was a dystopian nightmare. Thousands of banks failed. Millions of life savings were wiped out. The industrial heartland of America ground to a halt. Men who had been millionaires on paper just a week earlier were now standing in breadlines. The public narrative, pushed by the government and the surviving elite, was that everyone was equally guilty. They blamed the crash on a collective madness, a contagious greed that infected the working class. The people were told they had gambled and lost, and now they had to pay the price. But let us look at the final, sick paradox of this financial apocalypse. Let us look at Albert Wiggin, the chairman of Chase National Bank, the man who had secretly shorted his own bank's stock using a Canadian shell company. As the dust settled over the ruined lives of millions of Americans, Wiggin quietly closed his short positions. His personal profit from the destruction of his own bank and the broader market was $4 million. In 1929, money, and because he used the Shermar Corporation in Canada, this massive fortune was completely, legally, tax-free. He did not pay a single cent to the government. Did he go to prison? Was he ruined by the collapse? Absolutely not. 3 years later, after public outrage finally forced him to resign, the board of directors of Chase National Bank rewarded Albert Wiggin for his service. They granted him a massive, unprecedented pension of $100,000 a year for the rest of his life. The system did not fail. The Great Depression was not a tragic accident. It was the mathematically guaranteed outcome of a system designed to funnel the wealth of the many into the pockets of the few. The elites did not lose control of the machine. They simply extracted the last drop of fuel, safely detached themselves, and watched it burn from the high ground. The next time a financial expert tells you the market has reached a permanently high plateau, remember the shoeshine boys of 1929. Remember Albert Wiggin. I am the time weaver. The historical record is closed, but the machine is always running. Until the next cycle.